Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now till the closing bell, and stocks are rallying to the close, kicking off February with a bang. Our very own Jared Blickery is standing by with all the headlines. Jared.
Thank you, Josh. New month, nice rally underway. Let's take a look at the Dow Jones Transports here because we don't have a lot of records. I thought we'd start here because the index itself is at a record, and we're just seeing a lot of outsized movement, especially in the airlines. United up 4.5%, UPS and FedEx over 3%, Southwest over 4%, so is Delta. List goes on, but I'm going to go over the indices now, and we'll start with the Dow Industrials up 529 points or 1%. NASDAQ Composite up a little bit less, 0.6%, and the S&P 500 kind of neck and neck with the NASDAQ there, 0.6%. And I do like to track the Russell 2000. The small cap index is up 1.5%. And let's check out the bond market action here. We got the 10-year T-note yield up a few basis points, 3 to be exact, to 4.28%. The 30-year also on the move upwards. That yield is up 4 basis points to 4.91%, getting a bit closer to that 5% mark that has spelled trouble for stocks before, but not today. And here's the US dollar index going in the same direction as yields, up 0.2%, and so is Bitcoin for that matter, at least over the last 24 hours, did hit 74,000 and change. You and I are going to talk about that, Josh, later in the show. But let's get to the sector action, and let's see there we go. Here are the large cap sectors in the S&P 500. Industrial still in the show, up the most, 1.13%. That is good for a record high. Staples also about to notch its first record closing high of 2026. It's up 1% in between. Well, actually, there's financials and tech, all four of those up more than 1%. Energy, the worst off today. That is down 1.5%. Then you got utilities, real estate, and communication services in the red. And let's see how the NASDAQ 100 is playing out. A lot of strength in the chip stocks here. Apple also up 3.5%, Walmart up 3%, but let me show you what's going on in semiconductor land. If I sort by performance, you can see SanDisk up another 13%, WDC, Western Digital up 8%, Intel adding to its gains after that big wipeout a couple weeks ago. It is coming back, it is roaring back. But then in software land, we got a bunch of red once again. Not everything. SAP up 2, Cisco up 3, now up about 1. And IBM, why is that in there? Red hat. Well, IBM's up about 3 as well. And I will just close here on our leaders and show you that transports, that is IYT, that's a transportation ETF, up 2.5%, but regionals, biotech, each of those up more than 2%, and microcaps looking strong too, along with the stocks. What's not doing well? Well, this is since Friday. I just showed you Bitcoin is up today over the last 24 hours, but since Friday, it is down 6%. Josh?
All right, Jared, thank you. Well, gold is on a historic run while Bitcoin is struggling to keep pace, raising questions for investors like, is the market choosing traditional safety over digital scarcity? For more, we're bringing in Ryan Rasmussen, head of research at Bitwise. Ryan, it's always great to see you. So let's talk about Bitcoin here, Ryan, because this morning, Bitcoin actually touched, let me get this right, a 10-month low. It's now down, Ryan, about 40% here off that record high of about 126,000 in October. What is going on here? Help us make sense of this, Ryan. What are the pressures on Bitcoin?
Look, Josh, there's a lot of pressure on Bitcoin at the moment. As you mentioned, we're down more than 40% from the prior all-time high above 125,000. And so there is pressure on Bitcoin right now. I think part of that pressure is coming from gold taking the spotlight and other commodities taking the spotlight. And I think the other element of this is that we are just in the midst of a Bitcoin bear market. We've actually been in a bear market now for many months, probably more closer to a year. And so I think that's what's keeping Bitcoin down. We've now seen it kind of drawing down the most over that period overall. But nonetheless, it's a bear market. It's a bit dark right now in the crypto space, but we think there's brighter times ahead.
What are those brighter times ahead, Ryan? Walk me through. What are some catalysts 6 to 12 months out that you have on your radar?
There's a few major catalysts for Bitcoin that we see over the next year. First, emerging from this bear market is critical. Sentiment right now is at an all-time low, particularly amongst retail investors, which of course historically have driven the Bitcoin and crypto market more broadly higher. So while that sentiment reverses as we emerge from this bear market, that will be important. But I think more important than retail investors this time around for Bitcoin is institutional adoption. That's a major catalyst that's multi-years and long-term oriented. And we're seeing that happen at Bitwise in the conversations we're having with institutional investors every single day. Major wirehouses, RIAs, and family offices and the like are all starting to come around to Bitcoin. They're asking serious questions about making Bitcoin and crypto allocations. And that's a very long-term oriented catalyst.
So Ryan, with Bitcoin here around 78, do you all at Bitwise, you do targets, Ryan, like a year-end target for Bitcoin?
Yeah, our view this year going into 2026, when Bitcoin was trading around 93,000, when we published our report about 2026, was that Bitcoin would hit new all-time highs this year, and it would break what a lot of market observers have deemed this 4-year cycle that has historically plagued crypto. So we believe Bitcoin will be higher. Our long-term view for Bitcoin is more decades out than years out, and we believe Bitcoin will hit 1 million over the next decade, driven by institutional adoption that I just spoke about.
You know, there's another sort of storyline out there, Ryan. I'm just curious to get your take on this, which is, well, what about Trump nominating Kevin Warsh, right? Trump has said, okay, Warsh, that's my guy. That's who I want leading the Fed. Warsh, historically, Ryan, you know this, you would think of him as more hawkish, right? Concerned about inflation. And do you think maybe that's playing a role here? In other words, some folks thinking, okay, well, hold on, if it's Warsh, maybe not such loose monetary policy ahead. What could that mean for Bitcoin?
Yeah, Josh, it's a really good point. Warsh is a pro-Bitcoin person. It's important to note. He understands Bitcoin and is supportive of Bitcoin, believes it has a place in portfolios and that it's breakthrough technology and important to the world. I think that's really important. But you have that against the backdrop of him being seen as more hawkish and not, being for the growth of the money supply, which historically has been supportive of Bitcoin. So you have these two different sides tug of warring at each other when it comes to how it will impact Bitcoin. I think net, we will see interest rate cuts. The market's pricing in about 50 basis points of cuts over the remainder of this year. I think we will see that. Not to say Warsh isn't hawkish, but I think he'll be a bit more dovish than most people are expecting.
What about ETF flows, Ryan? I'm curious, just broadly for spot Bitcoin ETFs. You have line of sight there?
Yeah, so ETF flows for Bitcoin ETFs have been remarkable when you zoom out. They've been the most successful ETF launches of all time, in the tens of billions of flows in their first year and in their second year. But that has come down a bit over the past few months. As I mentioned, we believe we're in a bear market currently. And what that's led to are things like the basis trade, which is very popular around Bitcoin ETFs run by hedge funds. That has collapsed a bit. We've seen outflows from the ETFs because of that. As I mentioned, we've seen attention flow to other asset classes like commodities, like tech stocks. And so ETF flows have slowed. Corporate purchases, on the other hand, of Bitcoin are starting to reaccelerate. We've seen MicroStrategy buy tens of thousands worth of Bitcoin already this year. And we think that ETF flows will turn a corner as we have major wirehouses and other institutional investors onboarding Bitcoin ETFs to their platforms. Morgan Stanley, UBS, Merrill Lynch, Vanguard, all of these asset managers have approved Bitcoin in recent months for their wealth managers and their clients to invest in. I think that's a huge catalyst going forward, but it takes time. Not all of those wealth managers allocate right away. Some take months, some take quarters, some take years, but net, when you zoom out, that's a lot of demand for Bitcoin over the next decade.
I want to come back around, Ryan, to a point you made earlier. How much of Bitcoin's slide, Ryan, do you think we chalk up to excitement in gold, in silver, in the precious metals? In other words, how much do you think investors said, well, hey, that looks like a fun party going on over there. I don't want to miss out on that. I'm going to move there and not Bitcoin.
Look, as a Bitcoin guy, it's hard not to see what's happening in the gold market and think that's a fun party. I don't want to miss out on it. I think the gold trade has started as a push by central banks to increase their gold allocations in a world where having self-custody of assets, being able to move away from reliance on other governments and other central banks is important. And so we've seen central banks increase their purchases of gold starting really in 2022 and 2023, and it's been accelerating. I think now gold's turned into more of a momentum trade. We've seen the runaway price of gold and silver and other assets. So I do think that plays a bit of a role here when it comes to what's happening in the gold market. But the fundamental thesis for gold is that it's a way to store value outside of any government or bank and to custody your own assets in a world where you're worried about fiat debasement and you're worried about spiraling debt and irresponsible monetary and fiscal policy. And those same topics are things that we've been speaking about when it comes to Bitcoin for now over a decade. And I think that those themes are going to eventually land investors on the point that Bitcoin is a digital store of value, much like gold is a physical store of value. So I think the same themes drive Bitcoin higher over the next decade as have driven gold, but gold's in the spotlight right now.
Ryan, as always, great to have you on the show. Thank you.
Thanks, Josh.
Well, the magnitude of earnings surprises is above recent averages as of the end of January. According to FactSet, with 33% of companies in the S&P 500 already out with quarterly results, we're assessing the setup for earnings strength in 2026 with Jeff Schulze, ClearBridge Investments Head of Economic and Market Strategy. Jeff, great to see you. So start kind of bigger picture, Jeff. You raise a good point in your note. Some viewers might be they're assessing where we're at right now, Jeff, and stocks have had these terrific runs year after year, and you'll hear this storyline, this question, maybe we're parting like it's 1999. You've heard that, Jeff. You argue, no, that there are key differences between now and then. Walk us through them.
Well, look, if you look at it on the surface, yeah, we have high valuations, just like that time period. You've had a great run for the markets. There's an infatuation with growth stocks. But when you actually peel back the onion a little bit, there are a lot more differences than similarities. First off, on the economic perspective, you have the twin tailwinds of monetary and fiscal support that are going to hit the economy this year. And that is a combination that you rarely see outside of recessions. Secondly, wage growth continues to moderate. And while this is creating more of a K-shaped economy, it's good from a macroeconomic perspective because it's the key reason why the Fed has cut over the course of the last year and will likely continue to cut as we move forward. And the AI capex story still continues to be alive and well. So we think that GDP is going to come in above consensus expectations. And when you look at the market compared to the late 1990s, one of the key differences last year is that over 82% of the 16% return for the S&P 500 was driven by earnings delivery. Less than 20% was multiple expansion, which was a stark difference than what we saw back in the late 1990s. So with valuations remaining elevated, I think that's the playbook that you got to expect this year, where earnings will continue to do that heavy lifting and the markets are going to go higher.
Jeff, just speaking of stimulus, fiscal stimulus, that big, beautiful bill, Jeff, what kind of impact could that have on GDP this year? Have you crunched the numbers on that?
We have. And when you look at the Congressional Budget Office, they expect that it's going to boost GDP by about 0.9%, which is a pretty big move. And it's going to be half going to the U.S. consumer through higher tax refunds as we move through the next couple of quarters. And then the other half going to businesses with the tax incentives from the One Big Beautiful Bill. So when you put that together, that's a pretty strong impulse. And I think the key takeaway here is that there is some consternation about the consumer. The low end is struggling. With these larger tax refunds for low and middle income consumers, it's going to be a much more uniform spending picture this year, which is going to create a robust economy, more importantly, robust earnings.
So that's fiscal stimulus you're walking through, Jeff. About monetary stimulus, I mean, how many cuts this year, Jeff? What would be your base case? And should we be cutting, Jeff? When you look at Atlanta Fed GDP, I mean, we're sitting here at 4.2, Jeff.
Yeah, my base case is 2 cuts. We won't get anything until we get a new Fed chair towards the middle part of the year. But I think what's going to become apparent is that we're going to have much weaker inflation than what's anticipated. And the environment that I'm anticipating this year is going to be more like the jobless recovery that we saw out of the 2001 recession, where job creation is 60 or 70,000 per month, which is more than enough to support the consumer. But it's going to put pressure on inflation. And when you take in shelter inflation continuing to moderate, goods inflation moderating as we get through peak tariffs, that's a really good recipe for more monetary support, especially as some of these productivity gains from AI kick in a more meaningful fashion.
You mentioned AI, Jeff. What about all that hot talk of an AI bubble? You got Palantir reporting after the bell today, a true AI winner. It sounds like, though, Jeff, you don't buy that bubble talk.
We don't. Investors have consistently underestimated how much capex would happen with AI. You saw it with the hyperscalers. I mean, last year alone, coming into 2025, and what was actually delivered at the end of 2025, expectations were 50% lower than what actually transpired. And what we've seen time and time again is companies increase their capex expectations through guidance. So we think there's more room to run with this story, but a key difference today versus the late 1990s is that a lot of this this capex is being driven by free cash flow generation rather than debt or equity. You're starting to see that transition a little bit, but in my opinion, it's probably years away before this potentially causes a problem.
So bottom line, Jeff, I'll get you out of here on this. You sound constructive. It sounds like you're telling me, hey, listen, you're buying dips if they come.
We are. And it's going to be a choppy year. But I think the one misperception that people have is that valuations are stretched and the markets can't move higher. But similar to what we saw in 2025, if earnings come in anywhere close to consensus expectations of 15% this year, we think the markets are going to continue to move higher and could see another double-digit year of returns when all is said and done. So if we do get a buy the dip opportunity, we're certainly advocating for investors to take advantage of it.
Jeff, great to have you on the show. Appreciate your time.
Thanks for having me.
Coming up, we bring you the details on the U.S.-India trade deal. That's next on Market Domination. President Trump announcing a trade deal with India, saying both countries will lower the tariffs on each other's goods. Yahoo Finance's Washington correspondent Ben Wershkul joins us now on all this. Ben, what are the details of this deal?
Yeah, Josh. So Donald Trump and Prime Minister Narendra Modi of India spoke earlier today, and both have confirmed sort of the broad parameters of this deal, which Trump describes as sort of a very far-reaching agreement between the two nations, and Modi describes as the deal between the world's two largest economies. The big headline here is tariffs. Trump announced that reciprocal tariffs that the U.S. imposed will drop from 25% to 18%. Also, a White House official confirmed that Trump's 25% tariffs on India's purchases of Russian oil will be scrapped entirely. So that's a reduction of 50% to 18% on a lot of goods, which is a very significant, very significant drop, and puts sort of India in league with its neighbors. That's one of the factors that they watch most closely. In return, Trump says that India is going to stop purchasing Russian oil, do some investments in the U.S., and lowers their trade barriers a bunch of different fronts. But the details on that are pretty sparse, and Modi notably did not confirm the Russian oil purchase piece of this in his tweet to announce this forward. Overall, this is kind of a major step down, no matter, even as we're still trying to figure out the details here, puts India, after a year that they've had really troubled relations with the U.S., kind of in league with their late neighbors now, and kind of, as Modi said, setting up hopefully a partnership going forward between Trump and Modi on trade issues.
Now, Ben, another story you're watching is this government shutdown. We just got word labor market data being delayed. Polymarket, Ben, now betting on a 57% chance the shutdown lasts at least 5 days. Where are all lawmakers on a funding bill? What do we know?
Sure. Yeah. So we're 3 days into it now. So that's 2 more days from now. And there is the big arena is the House of Representatives right now. This is a bill that passed the Senate 71-29. So it's clearly showed the deal that was struck last week has kind of widespread bipartisan support. The issue we're seeing in the House is basically how many procedural roadblocks are going to be put up before it gets to a final House vote. We're going to get some clarity on that this afternoon. The House Rules Committee, they essentially set the terms of the debate and the vote going forward. They're going to try to pass what's called a rule there later this evening, hopefully setting up from their perspective votes for tomorrow. But and then there's a number of lawmakers that are planning to sort of try to attach bills to it that would make this more complicated. But the bottom line here is that there is an agreement to avert this partial government shutdown, and it's likely to go forward at some point in the coming days, and not have the kind of longer economic effects you're going to have of an extended shutdown. As you mentioned, the BLS data will be delayed starting this Friday. If it goes longer than that, you start getting into issues that we saw last year of data not even being collected because of these furloughed workers. But for now, I think that's about right. We're expecting a couple days more of shutdown, 1 or 2, and then this ends.
Ben, finally, let's talk about Kevin Warsh, because Trump telling reporters that Warsh, quote, should have no trouble getting through the Senate confirmation. What do you think, Ben? No trouble?
And he's definitely going to it's definitely going to be a bumpy ride that's ahead of him. And that's because of one senator, his name's Tom Tillis of North Carolina, who has taken a stand and has stuck to it in repeated comments since Warsh was announced, that he's going to block any nominees for the Federal Reserve over the issue of Federal Reserve independence, specifically the criminal investigation that has been launched against the current chair, Jerome Powell. Tillis has reiterated that this is his stand, and he has the power to potentially block this because he sits on the Senate Banking Committee. It's a 13-11 split right now. Tillis voting no with Democrats makes it 12-12, which means the nomination can't advance. So it's a significant blockage here, and Tillis is retiring. He only has one more year in the Senate, so he doesn't is kind of immune to political pressure. The thinking goes there. Overall, the way this ends, I think, is that there's some sort of deal worked out, there's some sort of ramp down of the investigation against Jerome Powell that satisfies Tillis. And this goes through. The timing here, I think, what people don't know is how long this takes. Is this works out in the next few weeks, works out in the next few months? Powell's term ends in May, so that's the timeline to watch, is whether this blockade stands through the end of Powell's term as chair.
Ben, thank you, buddy. Appreciate it. February off to a strong start with the Dow up more than 500 points on the first day of trading. Our very own Jared Blickery breaks down how stocks tend to perform in the month in the latest edition of Stocks in Translation.
It's already February, and stocks just notched a positive January, which greatly increases the odds that 2026 will close in the green come December 31st. But not to get too ahead of ourselves, we're going to dig into what typically happens in February and beyond. I'm Jared Blickery, host of Stocks in Translation. First, we need to break down the concept of seasonality, what it is and what it isn't. Quite simply, it is the recurring calendar patterns that we see in market returns year after year or on other time frames. But don't think of it as a definite prediction, just a tendency for prices to repeat historical behavior. Think of it as a way to set up expectations for market headwinds and tailwinds, and not as a timing tool for exact tops and bottoms. You can use it as context with other tools like market technicals and fundamentals, chart reading, etc. It's definitely not a standalone trading system. And with that out of the way, let's get to what happened historically in the S&P 500 since 1990. And a brief note, we could go back farther in history, and we're actually going to do that in a minute with a separate model. Suffice to say, there are lots of ways to slice and dice history, down to which year of the 4-year presidential cycle we are in. But here right now, we're just going to be looking back to 1990. And one more note, I'm looking at the median for each month instead of the average return. With averages, extreme highs and lows in individual years, they can skew the results. So you can see here that no month actually skews negative, and that January here is typically up 1.7%. And guess what? It was actually up 1.4%, so not far off. February is typically up less than that, about 0.8%. And another helpful stat to know is the win percentage, or how often it has closed green over the last 2.5 decades. That is 58% for both January and February, and it's not stellar. Actually, I like to see 70% or above because stocks tend to go up most of the time. You're also going to notice in the chart that March, April, and May are usually up over 1%, and I'm circling those now. The win percentages increase over these months so that April and May are both up over 70% of the time. And you can see a big difference over the rest of the summer and early fall months. The typical gains are pretty small, except for July, which is a big standout here, up 1.8%. And we typically end the year bullishly, with October through December up nicely. Now let's look at another way of mapping history. Here we go all the way back to 1928, but we do not use every single year. We only include the years where the day of the week matches the 2026 day of the week. For instance, for the first trading day of February, which is February 2nd, we only look at those years when that falls on a Monday. And for most of the days of the year, we get about 13 years matching over the last near century. And you're going to see in the chart that we tend to trend up into late April and then we take a bit of a dip into May. Then it's off to the races into the beginning of August, and then another dip into late September here, and then a big rally going into the beginning of December, and then we kind of go sideways to up into year end. And remember that these are just tendencies. And by the way, I have one more chart, and this is of the VIX's seasonality. Now, remember that VIX is the so-called fear gauge. Some people dispute that, but when the VIX goes up, stocks are tending to go down. And so we've had the VIX since 1990, and we can see that volatility starts out the year with an average or median of about 19. And this all goes all the way down to 15 because that's where we are right now. So we are actually lower than throughout most of history. But the volatility does tend to trend up into mid-March, then it takes a dip over the summer, then we get a large rise, and we get the largest readings of the year typically in October and November. That is prime time crash season. And you're going to remember from the other chart that we actually have pretty good returns on the median for those months, but the outliers are pretty big. So we have seen some pretty scary stuff happen in October and November of prior years. And then we have a reduction in volatility going to year end, and that's usually concurrent with that big year-end rally that we see into stocks. So all in all, seasonality is a handy guide to give you an idea where we might be headed, but what's actually happening in the market on a day-to-day basis can vary from it, and especially when we have big unexpected news like tariffs. So tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Coming up, fresh uncertainty around the AI trade. We'll look at why Nvidia's latest investments may be leaving some investors on edge. AMD getting ready to report fourth quarter earnings on Tuesday. For more on what to expect, we're bringing in Yahoo Finance tech editor Dan Howard. Dan.
Yeah, Josh, this is going to be a big indicator for the AI trade, just as we saw from Meta and Microsoft. They had wildly different results when they reported last week. Huge reactions to them as well. Obviously, Microsoft losing a huge amount of value, then Meta seeing a jump. But this will give us a better sense of what the spending is going to look like going forward for those companies. They obviously both raised capex, and we're expecting Amazon and Google to do the same. And a good chunk of that goes to AI chips, and AMD makes AI chips. So for the quarter, we're expecting AMD to report EPS of $1.32 on revenue of $9.6 billion. That would be up from the $1.09 and $7.7 billion they had in the same period last year. On the data center side, we're expecting $4.97 billion in revenue. That's a 29% increase. On the client side, now this is where PCs come into play. We're expecting that to top out at $2.9 billion for the quarter. And then on gaming, that's going to be around 1.3 billion, 800 million in that range for the quarter. And so these are going to be some big changes for the company going forward. And we're expected to hear more about their new chips from CEO Lisa Su. She had talked about those at CES in January. Their Helios platform, that's going to be a large server system, as well as their new PC chips that are coming out.
Dan, another question, and it's a broader one, not just relevant for AMD, but the impact, Dan, of this memory shortage on the PC industry. How should we be thinking through that as consumers, as investors?
Yeah, I mean, this is going to be something that's going to persist for a while. I was just speaking to some analysts about this because I'm working on a piece related to, the memory shortage and the storage shortage. Because it's not just RAM. We talk about HBM, things like that, but it's not just that. It's also the storage where data lives long term. That's also in short supply because of this AI build out, and so that's going to impact potentially the prices of PCs. Basically any consumer device that uses RAM, which is most computers, and so we could see a rise in price for PCs, and that could cause demand destruction, which could then impact AMD as well as rival Intel in their client side. So we're really going to have to keep an eye on that and what it means for those particular markets. If it's low margin products, the lower cost PCs, they could increase in price, or we'd have to see AMD take a kind of a hit from that margins decrease. If it's a high end, they may be able to just, increase the price slightly, not see as much of an issue. But I mean, this is going to be something that lives on for quite some time. It's not like they can stand up factories overnight.
And finally, Dan, just quickly, what does AMD have coming down the pike, Dan, with their upcoming GPUs?
Yeah, they have a new GPU that they had announced at CES. That's going to be their next generation system. They say it's 1,000 times got 1,000 times better performance than 2 generations ago system. Their MI300s. This would be the MI500, and so that's going to be their next gen system. They also have, as I said, that rack scale system called Helios. That Lisa Su, the CEO of AMD, had said is the best AI server in the world, which is clearly just a swipe at Nvidia, which obviously has its own rack scale servers and those NVL72s. The Helios will also have 72 GPUs built in and should be quite a behemoth when it eventually does start getting built in to these data centers. So we'll just have to see what the response is to those, and then if more cloud companies start to buy in and buy up what they have out of AMD. Dan, thank you. Appreciate it. Uncertainty around the broader AI trade simmering as Nvidia CEO Jensen Huang downplays the chipmaker's pledge to invest in OpenAI. This comes after the Wall Street Journal reported the $100 billion plan was on ice. Austin Lyons, Creative Strategies senior analyst, joining now for a closer look at the AI investing landscape. Austin, it's good to see you. So let's start on that big headline. We all saw it, Austin. Certainly made some news and got a lot of attention. That $100 billion Nvidia OpenAI deal on ice. That's how the Journal put it, Austin, citing sources. What do we think happened here, Austin? What changed?
Yeah, it's a good question. And everyone's wondering, if you go back to September, there was the announcement between Nvidia and OpenAI about the partnership where there was going to be up to $100 billion invested for up to 10 gigawatts of data centers stood up by OpenAI. So the idea was, as OpenAI stood up each gigawatt of data center, they would unlock investment from Nvidia, and at 10 billion, let's say, for every gigawatt. Now, of course, at the time, there was a lot of conversation around circular financing. It felt very interesting to have a vendor investing in a customer as they buy more of the vendor's chips. Now, shortly thereafter, within the next month, OpenAI had several more announcements with specifically with AMD and with Broadcom that were sort of very similar. So with AMD, it was also, if you stand up MI450 Helios racks, OpenAI, then they would unlock investment from AMD. And actually, they were even going to get warrants in AMD, so start to own some of AMD. And then there was the announcement of OpenAI and Broadcom building a custom chip together. And so there's definitely some questions if this competition led NVIDIA to feel like maybe this wasn't the right structure, and sort of the optics are that OpenAI is kind of hedging its bet here and trying to find all the compute that it can with different vendors. I think more likely the talking that NVIDIA has done about it so far, you could also interpret it as just they're shifting from that style of funding to just a direct equity investment, which has less of the concerns around the circular financing. It's just NVIDIA believes in OpenAI and is investing them, and therefore OpenAI is able to do whatever they want with that money.
Another kind of broader question, Austin, is I wonder, some viewers might be wondering, why does NVIDIA's Jensen Huang, why does he want to invest in OpenAI and Anthropic in the first place? Like, what's the move? What's the strategy?
Yeah, so that is a great question. So the way that I interpret what Jensen has said all along is that Jensen believes that his vision is that the whole world, every industry is going to be transformed by accelerated compute, by AI. And so if you put yourself in his shoes, your question is, how can you ensure that that vision happens? Obviously, these AI model companies are a big piece in creating that future. They obviously have to train the models, inference them, get them into the hands of customers, support them, build consumer products around them. And Jensen is, as an infrastructure platform, he's really incentivized to help make sure his partners can bring value to end customers. So of course, Nvidia has lots of money to invest. And so that not only are they investing in making their platforms better, but it would make sense that they would invest in their partners to ensure that their partners can, bring that future to bear as quickly as possible.
If OpenAI stumbled, Austin, and who knows, I mean, Google Gemini, coming in hot. If Sam Altman stumbled, how exposed would I be to that stumble as an Nvidia investor?
Yeah, that is really an interesting question. So, what Nvidia investors should feel confident about is that over the past several years, we've seen diversification. It's not just OpenAI anymore that makes these models. It's obviously OpenAI, it's Anthropic, it's Google, of course, but then there's also open source options, and then even XAI, for example, came into the race late and is able to kind of catch up and participate. Obviously, OpenAI is a very big customer. They're driving a lot of usage. Microsoft buys a lot of Nvidia GPUs, and it's to serve OpenAI's models. So if OpenAI were to stumble, that would obviously impact demand for compute across the industry. On the other hand, they aren't the only ones. Google's out there. Google, of course, has their own TPUs. They also buy Nvidia GPUs and rent those out as well. And so Nvidia doesn't have all its eggs in the OpenAI basket, but of course, there's definitely quite a pile of eggs in OpenAI's basket.
By the way, Austin, recent forecasts, you saw this, by OpenAI, annualized revenue has surpassed $20 billion in 2025, and that's up from $6 billion in 2024. And correct me if I'm wrong, Austin, I think they've put $100 billion as a possibility by 2028, I think. What do you make of those numbers, Austin? Do you believe those numbers? Are they credible in your opinion?
I mean, I believe $6 billion and $20 billion for sure. The question is on the projections. I think given how much, even just looking at myself and people around me, how much AI usage has transformed from 2024 to 2025 into 2026, which is probably going to be the year of the agents. We see all these Claude bots and Claude code taking off. I don't doubt that by 2028, we're going to have a ton of AI consumption in our everyday lives. And then, of course, you might even see new form factors like smart glasses taking off and so on and so forth. So I don't doubt that there'll be a ton of consumption. I think there's obviously big questions around, will that turn into $100 billion of revenue for OpenAI? Will it turn into $100 billion of revenue for Anthropic? Hard to say. We don't quite know. A lot of those numbers are private. On the other hand, they're both talking about going public, maybe even as early as end of 2026, in which case we would see a lot more into their numbers. And OpenAI is even working on an advertising system, and that would help drive revenue. Google and Meta are very good at generating hundreds of billions of dollars of revenue from advertising, so I don't doubt that OpenAI could figure out that as well. So they definitely have lots of irons in the fire. I'm confident that revenue will be up. Will it be $100 billion? Hard to say.
Finally, we're talking NVIDIA and OpenAI, Austin. We also had this news from Oracle saying they're going to raise around $50 billion to fund their AI infrastructure build out. What kind of, Austin, what does this all tell us, in your opinion, about where we are in the kind of great AI capex cycle?
That's such a good question. It's such a deep question. Obviously, demand is very high, supply is limited. Everyone's trying to get in on that game. Oracle is willing to raise money. So obviously the hyperscalers and the traditional cloud players are using their own balance sheets to fund the capex build out. Oracle is sort of the first really big person to go raise debt and try to participate and become a hyperscaler. We will see how it shakes out. I think there's a lot of strategy behind what they're doing and the type of customers they're going after. But we are in the early days, and it's just hard to say. Well, ask me that question again in a year. But I definitely think that Oracle's signal is that they believe that it's worth it. They believe that the risk is worth it, and that the pie is expanding, and that they're willing to take on the risk of debt to participate.
Austin, as always, so good to have you on the show. Thank you.
Thank you.
Coming up, Disney closing in on naming CEO Bob Iger's successor. We give you the details on one of the reported candidates. That's next on Market Domination. The wait for Disney's succession plans could finally be over. The media giant's board is expected to vote on its next CEO as soon as this week. According to multiple reports, the candidates have been narrowed down to Dana Walden, co-chair of Disney Entertainment, and Josh D'Amaro, the chairman of Disney Experiences. Bloomberg says it's likely to be the latter. Market Catalyst host Julie Hyman gives us the lowdown on who D'Amaro is and gets an investor's perspective.
Who is Josh D'Amaro? In his current role, D'Amaro oversees Disney's global theme parks, resorts, cruise line, consumer products, and Imagineering. He joined Disney in 1998 and he rose through the ranks with leadership roles at Disneyland, Walt Disney World, and across international parks. D'Amaro was named head of the parks business in 2020, taking on that role during the pandemic and helping lead the division through reopening and subsequent expansion. Now, under his leadership, Disney Experiences has emerged as the company's primary profit driver, accounting for a majority of Disney's operating income, in recent years outpacing media, streaming, and sports. That business includes 14 theme parks across 3 continents. It attracts nearly 150 million visitors annually, along with Disney's growing cruise line fleet. A decision would mark a major step in Disney's CEO succession process, which has been overseen by the board and led by Chairman James Gorman since 2024. One final fun fact, Josh D'Amaro and Bob Iger have the same birthday, February 10th, though not the same year, obviously. So we'll be following this whole process to see who ends up actually getting the gig. Meanwhile, Disney shares are under pressure after the latest earnings results. Despite beating estimates for the latest quarter, the outlook for growth is being viewed as tepid. Joining us for more, Chris Morangi, Gabelli Funds co-CIO of Value. Chris, it's good to see you. What's your assessment of that outlook? Do you view it as tepid as well? I mean, certainly that's what the shares seem to reflect.
Yeah, no, I think the expectations for earnings are as strong today after this report as they were Friday. This is the company's first fiscal quarter, and very unusual for them to increase expectations. So, they basically hit all their marks in terms of earnings for that calendar fourth quarter, and I'm not surprised to see them reiterate.
Are you surprised to see the shares down then?
I am a little surprised. I think if you dropped in from another planet, you'd see operating income down 9%, adjusted EPS down 7%, and would say that's not great. But in fuller context, those are pretty good numbers as the company goes through a transition from traditional linear distribution to direct to consumer.
And where are they in that transition? And if they do pick Josh D'Amaro as the next CEO, does that reflect that as well?
Well, both candidates are terrific leaders, well known to Wall Street. But this is an experiences company. More than 2/3 of earnings and probably 3/4 of the value of the Walt Disney Company is in the experiences business. So I wouldn't be surprised to see Josh D'Amaro as the CEO. That's probably the future. But the company is far along in the transition to DTC. They're like many other big media companies, experimenting with bundles and the reaggregation of distribution. And they're being pretty successful.
So, Chris, as you watch this latest succession process, we already went through this once before, obviously. What's your level of confidence that Disney's going to get it right this time, that it's going to stick?
Yeah, there was the interlude of the two Bobs, obviously, right. With the CEO who took over from Bob the last time a few years ago, coming from the experiences business as well. But listen, that's ancient history, and I think it's time for Bob to move on. He's done a great job in there for over 20 years. Very successfully pivoted the company to the two businesses that are growing in media. That's experiences and sports, and he deserves a lot of accolades for that.
He deserves a lot of accolades. I mean, is he going to be able to step aside, right? I mean, one of the problems with the two Bobs before, it seemed, was that Iger did not have enough confidence in what Chapek was doing, was sort of, looming over him and maybe still making some decisions. Do you think that Iger's really going to be able to step back this time?
Well, maybe that we'll consider that practice, and we'll be able to get it right this time. Listen. Obviously, we've seen a lot of big shoes to fill in a number of different companies. These are big shoes, but it is a different time in the media business. And I think Josh will have a great opportunity, or Dana will have a great opportunity to reinvigorate some businesses that are pretty well positioned for an acceleration of growth.
Now, you talked about the transition that the business is making here, and I'm curious what you see as the future of the filmed entertainment business, which, as we know, has been really challenged and probably is going to be further challenged as we see more AI-generated content. As you look, I mean, because I know you are invested in many of the other media companies, do you think they're all going to be challenged by this transition? How is Disney positioned in that way versus some of its competitors?
Yeah, listen, the advent of AI is going to change this business in ways that we probably can't even predict today. And, this has a lot of echoes of the internet adoption, 25, 30 years ago. And what was that going to do? And so far, Disney has taken the approach that we need to embrace AI. They signed a deal with OpenAI to allow users to use Sora and to upload that content. So I think it's a wait and see. So far, Disney's done what they can, which is to produce great content, great IP. Zootopia 2, the biggest grossing animation in history, very popular in China. And that's what they're going to continue to do. And the value of that IP, I think, has been underscored by the battle that we've seen for Warner Brothers Discovery.
Chris, I look at a 5-year chart of Disney shares, and they've gone virtually nowhere in almost 4 years of that time. Is this stock a value trap? I mean, what needs to happen for it to break out? And do you think investors should be getting in here, awaiting that sort of breakout?
Well, their chart looks better than a lot of other media companies. The linear media business has been cyclically challenged, and Disney has done a pretty good job of dealing with both of those. I think if you step back to the beginning of Bob Iger's CEO-ship of this company in 2005, the industry has been turned totally upside down. Obviously, with the advent of the big media companies, with YouTube now arguably the biggest media company in the world, and the Disney company has also turned upside down. It was always the premium media company in the world with the best linear cable network. That was ESPN, and the best studio. Those are probably still true, but obviously the company has pivoted and is now led by experiences. I don't think the value of experiences is going to go down. It's probably even more valuable as we go to this world dominated by AI.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.